Hello, good morning and welcome to this morning call. It's Friday, March 22nd. A week that gave us another major surprise. The very dovish outcome of the FOMC meeting seems to have faded, or the impact seems to have faded fairly quickly. The dollar, as we can see on the chart here, is the euro dollar following the spike higher retraced some of its gains yesterday. So basically, as John Hardy will write about in his morning update on home.saxo this morning, is that we've had another failure for the dollar really to change direction here. So we are still continuing to be stuck in this months-long range here. The stock market's the same picture here. We are following a little bit of a muted reaction to the initial announcement. We saw stocks surge higher yesterday. You can see the Nasdaq here. We are now approaching the highs from last October. The problem is obviously with that is that it's tying in with it's at the same time we're seeing bond yields continuing to trade lower. We've seen the 10 years, you can see on the chart here, that we are trading at the lowest level since last January, and at the same time the 2 to 10 year yield spread is toying with 10 basis points, i.e. it's still pointing towards the increase of risk of recession. So something's got to give, but at this stage the stock market is clearly not in any mood to reverse some of the very strong gains we've had in recent months, even though some of the uncertainty most certainly persists after the warning from the FOMC that they see some clouds on the horizon. Staying with yields, another place where we're seeing a depression in yields is in Germany. The yield there on the 10 year is approaching zero once again. This is for the first time since 2016. We got some PMI data out later today, which may potentially push that over the edge if we get another disappointment. But nearly 0% yields, and again we're probably back to the core reason why stocks are continuing to move higher. A lot of funds around, a lot of capital that needs to be put to work, and bonds yielding at these kind of levels continue to attract demand into the stock market. We can't avoid not talking about the UK and the Brexit. Yesterday, at one stage, we had quite a significant slump in cable. That was on worries that we were basically approaching a no deal. But last night in Brussels, the EU granted the UK a 2 weeks extension before they have to declare what they want to do. And the market is really interpreting as giving Theresa May a bit of a strong hand here, because she can now basically go back to the Parliament and say, back my vote for the third time. And if you don't, then we are facing a very, very long delay, and it could mean that some of the Brexit voters who have been skeptic about her original or her current plan, they are basically going to join and finally agree to the deal. So the market, in response to that, did see a little bit of a push higher. We can see on cable here that big drop yesterday, which has been somewhat reversed. But overall, again, the only thing we can assure going forward is plenty of volatility, because the markets, we are still very much in the dark with regards to where this is going to take us. Looking at some of the other markets, in crude oil, we have mentioned that over the past several days here, we continue to track higher. We did find a little bit of resistance yesterday. Looking at WTI, we broke $60. We have retraced half of the sell-off from October to December. Brent crude is struggling a little bit to keep up with the same pace, so we're seeing a bit of a spread contraction between the two. It's primarily due to this big slump we've seen in stock levels in the US over the past couple of weeks, especially this week where they tanked by 10 million barrels. That has providing some additional support to WTI. But overall, the drivers right now remains the supply cuts from OPEC, but also this risk on that we have filtering through from the stock market. So as long as the macroeconomic outlook does not deteriorate, i.e. we don't see any nervousness in the stock markets, then there's not really any major reason for selling oil at this stage, because the supply side is supportive of the price. So, but we have to keep a close eye on incoming data and see how the stock market behaves. That's probably where we potentially could see some of these strong gains recently being reversed to a certain extent. Two commodities we are talking obviously a lot about trade wars and a trade deal which seems to be continue to be postponed. There's a meeting next week in Beijing, but the U.S. officials has basically toned down the chance of a deal to be reached at this stage. So the market is carrying on as if nothing had happened. It was getting lifted during January and February in expectations of a deal. Now that the deal has kind of faded a bit, the market continues to move higher. So that seems to be ignored a little bit at this stage. But and one of the keys is obviously trade, and two commodities where we are seeing a pickup in trade is these two, as you can see in the chart here. We're seeing breakouts both in cotton and not least in lean hogs. We have a swine fever outbreak in China, which so far has resulted in more than 1 million pigs being slaughtered over the last year. And that basically means right now China is almost telling the world, whatever you have, I'll have it. And that is putting a very strong bid into the US hog market, and yesterday I believe we were limit up once again. We've seen a couple of those in over the past couple of weeks. So a very strong move, driven by a very strong export demand coming in from China. Cotton as well is due to raised export export demand, but also the fact that the cut report, the speculative interest in recent weeks has shown that the net short was hovering close to a 12-year low or 12-year high. So that needs to be some of that needs to be reduced, and that's also providing that extra bit coming into cotton right now. Overall, the agricultural space has been down and out for quite a while. We are starting to see a few signs of support coming in. We have some very heavy floodings across the U.S. Some of the key belts, growing belts right now. It's impacting winter crops, but it also potentially leading to a delay of the spring planting. So there is some support coming in, which the market basically needs. They need weather-related support because of the inventory levels are so high as they are. But for now, the soft commodities, cocoa and coffee, they remains the one that remains under pressure. Especially coffee, we've seen current prices being below cost of production, but it's so far it's not having an impact on the prices. So we are multi-year lows there. Right, let's before we head into the weekend and the rest of the day, let's just take a look at the calendar. As I mentioned, we have the Eurozone flash PMI coming out this morning. There is some expectation that the composite is going to show a slight pickup from last month, so 52 versus 51.9. That could indicate that if realized, that we are seeing Europe stabilizing here, and potentially, even though we saw those bond yields approaching 0%, provide some support to the euro dollar. Elsewhere, we've got retail sales from Canada. Canada and Australian dollar are probably two of the currencies that we are a little bit lukewarm towards in terms of strengthening against the dollar, because we got housing issues in both these countries. So, but for now we're going to look at CPI and retail sales, and then just this afternoon PMI as well from the US, as well as existing home sales. Right, we'll end it there. We'll talk more about Brexit on Monday. We got John and Peter back in the studio then, so we'll have a little bit of a wider scope. But until then, have a safe trading day and a great weekend, and see you again on Monday. Thank you.